If your advisor handed you a letter that said you were investing in the S&P 500 at one of the most expensive points in history, and historically looking back at the current price, your returns don't look good, would you sign that letter? In today's video, we are going to talk about a tool that you can use with your financial advisor to make more deliberate investment decisions. And so let's talk about this letter. And let's talk about why we're using the S&P 500. Well, the reason we're using the S&P 500 is because one, it is pretty expensive and it's a good thought experiment here. But number two, and I think more importantly, is most investors have exposure to the S&P 500. It is probably in your portfolio and you should be looking at that and saying, okay, if that is a part of my portfolio, why? Because with investing, we're professional allocators of capital. You don't have to invest your money everywhere. You can choose. And if you don't like the risk return trade-off of a certain investment, you just don't have to put your money there. And so we'll use the S&P 500 for this example. But let's look at this letter. So it should have 3 points here. So point number one is you acknowledging that you understand the current price you're paying for an investment. Point number two is, given the current price that you're paying, historically, how have these investments done at the price you're paying? And point number three, given the current price and given the history of returns at that price, what is the compelling reason why you would want to invest your capital in this asset? Now, I would leave that to your advisor if you have one. They're going to be the ones that saying, here's why we're doing what we're doing. And it needs to be clear and concise. And so let's apply this to the S&P 500. So point number one, what is the price that we're paying? Well, in today's video, we're going to use the CAPE ratio, which means cyclically adjusted price to earnings ratio, which is just a fancy way of saying, okay, how expensive is this relative to the price that we're paying given historical numbers? And you can look at this chart right here. Currently, the S&P 500 is trading at a 39, depending on the day, CAPE ratio. Where does that land? As you can see, that is pretty high. The only other time it has been this high was in 2000. Now, if you don't know how the markets did in 2000, well, from 2000 to 2010, the markets had, the S&P 500 in particular, had what's called a lost decade, which means it had 10 years without positive rate of return on an annual basis. So you essentially broke even for 10 years. You made no money, which is not great. Now, primary reason for this is just stocks got expensive. Here we are again. And so given that, we need to make sure that we understand that we know the price we're paying and we understand the history at that price. Let's look at a little more history. So this scatter plot here gives us on one axis, we've got the price that we're paying. And then on the other axis, we've got your rate of returns over a 10-year real basis, which means your 10-year annualized rate of return after inflation. Okay, so how are you doing each year after inflation? Well, as you can see, as we go over to the right, at that higher price to earnings ratio and where we are now, the numbers do not look great. We actually don't have a positive dot, right, or a positive 10-year experience at this current price point. Now, does that mean that if you invest in the S&P 500 today, you cannot make money over the next 10 years? No, it does not mean that that is impossible. All it's giving us is history around when you pay a lot or a little for an asset, how have your investments performed in the past? And so point number one, the S&P is currently trading at a 39, right, cyclically adjusted price to earnings ratio, that you understand that. Point number two is that you understand that at this current price, the market has, the S&P 500 in particular, has historically underperformed its normal rates of return, which makes sense. You pay a lot for an asset, all else being equal, you get a lower rate of return. You get a great deal and you pay a little, all else being equal, you get a higher rate of return. Okay, so it's currently at this ratio, and at that ratio, you're getting a lower rate of return potentially. You're writing that you understand that. And number three is where your advisor comes in and says, okay, if my advisor is recommending that we are in the S&P 500 for a large or reasonable portion of my portfolio, given those two facts, which you may or may not be comfortable with, then they should have compelling points why you are in this investment, why you're allocating your hard-earned capital into this investment. And so you can have 3 blank lines that just says, write in 1 point, 3 points, 5 points, however many points you have on, given its current price, which is pretty expensive, given its history, which is not great, knowing those two things, why are we investing our capital here? And so what's the point here? The point here is this is a thinking exercise that when you look at this for expensive asset classes, you should have compelling points on number 3, why you are still putting money in this asset or any asset. Because some investments are expensive, some are cheap, but you should always be knowing, what are we paying today? What has history told us about what happens when we pay that price? And then knowing that, what are our reasons that we want to proceed, that we want to continue? Because you don't have to allocate to every asset class. You get to choose. It's your money. And so, number 1, price we're paying. Number 2, historically, what has that meant for me as an investor? And number 3, given that, why should we do it? What is our expectation or our story about the future that makes this a good use of our resources? I hope you found this helpful. And as always, thanks for investing your time with the Personal CFO.